Okay.
Good morning, good afternoon, and especially good evening to the viewers in Asia, since it's 9 p.m. here in Hong Kong. As you can see, it's dark in our office where Ruchir sits right now. Welcome to our first AFC Asia Frontier Fund update, which we would like to hold in the future on a half-yearly basis. My name is Thomas Hugger, and I'm the CEO and founder of Asia Frontier Capital. With me today is Ruchir Desai, who is managing with me the AFC Asia Frontier Fund. This webinar will last about 45 minutes, and thereafter you will have the opportunity to ask questions during our 15 minutes Q&A session after the presentation. You can submit your questions online through the Q&A icon at the bottom of this Zoom video on your computer or on your mobile phone. Nobody else besides the AFC staff will be able to see your questions. Ruchir, next, please. Just a quick disclaimer for regulatory reasons from our compliance department. Since you all have read and understood all these items now, I will start the presentation. As you can see on this map, the AFC Asia Frontier Fund actively invests in 15 countries in Asia. And we just did for the AFC Asia Frontier Fund last month the first investment in Georgia in a banking share listed in London. So it's from Bangladesh over Pakistan, Sri Lanka to Mongolia and down to Papua New Guinea. And of course, Sri Lanka and Vietnam, our major markets, as you can hear later on. Next page, Ruchir, please. As of 30th September 2021, the biggest country allocation was Mongolia with 20.1%, followed with 15.2% in Vietnam and 11.9% in Bangladesh. 28.2% of the fund was invested in consumer stocks, 21.8% combined in the AFC Iraq Fund and the AFC Uzbekistan Fund, and 13.7% in companies from the industrial sector. I hand over now to Ruchir, who will talk about the fund's recent performance, the general macroeconomic situation in some of the fund's most important countries, the outlook, and the highlights on some investment themes and some of our fund holdings. Ruchir, it's up to you. Thank you.
Thank you, Thomas, and also welcome everyone to our webinar, which Thomas mentioned we'll plan to hold on a regular basis as well. So what I'll do is I'll just walk you through how performance has been for the fund so far this year, what have been the drivers of performance, what are some of the structural trends we're seeing, and also talk a bit about the outlook and some of our topics that we like in our markets. So just starting off with that. So if you look at the chart on this slide, basically the performance this year has been very strong. In fact, the performance has been very strong over the last 12 months. And in fact, it's been very consistent. It's been 6 quarters of consecutive positive performance for the fund. It's not that it's been 3 or 4 months of good performance and then 3 or 4 months of flat or negative performance. It's been consistent throughout the past more than 12 months now. So 6 quarters of positive performance. And in fact, over the last 18 months, we've only had 3 negative months, which just shows the stocking capabilities of our team or of our strategy as well. So it's been pretty consistent. And also the performance has outperformed most major indices or major indexes. I mean, if you look at our performance so far this year, it's plus 19.1%. This is as of September 30, 2021. While the MSCI Emerging Market Index was, in fact, was slightly negative for the year so far, and the MSCI World is up about 13%. So it just shows the outperformance, a large outperformance versus some of the other larger markets in the region. And also, this shows not just positive performance or good stock picking, it also shows the lower correlation of Asian frontier markets between, the low correlation of Asian frontier markets with, larger emerging markets like China or India, and also, of course, developed markets. So, Asian frontier markets are not really impacted by what's going on in China in terms of the economic slowdown or the issue with Evergrande or the real estate crisis or the power crisis as such. So it is pretty much uncorrelated. I mean, what happens to Evergrande doesn't really affect Bangladesh or Pakistan or Sri Lanka, and not even Vietnam for that matter. And just talking a bit about the performance a bit more, these are some of the positive contributors for the performance. So it's been pretty broad-based, as you see on the left-hand side of the table. It's not just one specific country or a few stocks which is helping performance. It's pretty much across the board, and it's both commodity exporting countries like Mongolia and Iraq and Kazakhstan, also other countries which basically are more diverse in terms of the economy, like Uzbekistan, Vietnam, Bangladesh, and Sri Lanka as well. So it's pretty broad-based performance this year. On the negative side, it's marginally negative. It's Myanmar, Pakistan, and Cambodia, and also the exposure to both Myanmar and Cambodia right now is extremely small. It's less than 2% of the fund. So it's not that it's good. It's slight negative performance has really hurt overall performance for the fund as well. And even Pakistan, our weight over there is less than 10%, and the market over there has only been weak over the last probably 2 or 3 months, especially post the issue in Afghanistan when the Taliban took over. So there's some tension amongst investors, but other than that, no major issues in terms of hurting any major headwinds for performance so far this year. And just coming back to what I was mentioning earlier, Asian frontier markets are not really that much correlated with larger emerging markets in the region, and of course with developed markets as well. And as this chart shows you, Asian frontier markets have not really done well. They've outperformed by a very large margin. So it's not a small outperformance, it's a very significant outperformance. And of course, Mongolia is the best performing market so far this year globally because it benefits a lot from higher commodity prices, and also it's exporting or its exports are benefiting from the China-Australia geopolitical tension as well. But even the other markets like Kazakhstan, Sri Lanka, and Vietnam and Bangladesh, I mean, their performance is significantly better than some of the other emerging markets or larger emerging markets, especially in Asia, like Philippines, Malaysia, Thailand, and Indonesia. So this is a pretty wide outperformance versus the other markets in the region. And even, of course, against the MSCI World Index, most Asian frontier markets have outperformed so far this year. And it's again, as I mentioned earlier, it's a mix of commodity exporters as well as non-commodity exporters which have done well so far this year. And just talking about why Asian frontier markets have done well, and the performance has been strong, not just for the past, I would say so far, the past 9 months so far this year or 10 months, but it's been strong pretty much since March 2020, so more than almost 18 months now. And there are some key reasons why performance for Asian frontier markets has been so strong over the last 15 to 18 months. So as the chart on the top left shows you, central banks last year, of course, this is a global phenomenon, it's not just Asian frontier markets, but within our markets, I would say within the region, Asian frontier markets, the central banks in Asian frontier countries cut interest rates very aggressively. So as you can see, Pakistan cut interest rates by 625 basis points last year in a span of probably 4 to 5 months. And that brought a lot of liquidity into the market. And even countries like Sri Lanka and Vietnam have cut rates a lot to support the economy, to support in general the businesses and also the consumers at this time of the pandemic. And that brought in a lot of liquidity into the domestic market, and that brought a lot of retail investors into the market. Just to give you an example, in Vietnam, you were seeing in the domestic retail broking industry about 15 to 25,000 domestic retail accounts open every month pre-pandemic. But now you're seeing, at least so far this year, for over the past 6 or 7 months, you're seeing more than 100,000 accounts open every month. So it just shows you how interested domestic retailers have got into the stock market because of lower interest rates. And also, I guess they're sitting at home. So that's, I think, global phenomenon as well. And of course, just to add to that, interest rates has started to increase. I mean, that's probably a question we'll get. Pakistan raised rates by 25 basis points last month. I think they'll raise again next month as well. And even Sri Lanka raised rates by 50 basis points in August. So you're seeing the cycle turn a bit, but as long as rates don't increase, in a very steep fashion, I think the market sentiment should be okay in our universe. And also, I would say that as the chart on the right shows you, the pandemic was pretty well managed in our markets. I mean, you had all these various variants and Delta variants and various lockdowns and various waves of cases. But if you look at the chart on the top right, the cases per 1 million of population is still extremely low in our markets, because obviously the population or the average age of the population is very low in our markets. For example, Pakistan has a average age of about 23 or 24, and Bangladesh is about 27. So very low, very young population, which has kept this under control compared to, say, some of the Latin American markets like Brazil or some of the African countries like South Africa. And because, kind of countries managed the pandemic quite well, there was liquidity in the market. Overall manufacturing or industrial production or in general, industry has recovered very strongly in our markets. So as the chart on the top left shows you, export recovery has been extremely strong across our markets. Of course, the yellow line is Vietnam. It didn't really have much of an impact because of the manufacturing shift and supply chain shift into Vietnam and the higher exports to US. So they didn't really see much of a decline in exports. But the other countries like Bangladesh, Pakistan, and Sri Lanka, they've all gone back to, in fact, or some of them have gone back to higher than pre-pandemic levels, with Bangladesh and Pakistan showing 15-20% export growth for the last couple of months. In fact, Bangladesh just recorded its highest ever export growth, monthly export growth for September, about 40% year over year, because of, they've seen their order books fill up. And even Pakistan, the textile companies or garment companies there, they've got their order books filled for, I would say, the next 6 or 7 months. So it's pretty good times for them right now. And even on the chart on the top right, worker remittances have come back very strongly. There were concerns, 18 months back they would drop, but they didn't. In fact, they've come back very strongly, especially in Bangladesh and Pakistan. They've been growing at about 20% over the last couple of quarters. And the remittances not only help in balancing the current account, but more importantly, especially, I would say, not just in our markets, but in emerging markets in Asia, the remittances really help in consumption. They really help household spending, because when a family receives money from abroad, besides saving, they also spend it on consumption, like buying a car or renovating the house or actually buying a new house. So it really helps consumption as well. And that's come back pretty strongly in our markets, which have helped the overall economy also do well. And just talking a bit about earnings, the earnings have come back very strongly in our markets. If you look at the chart on the top left, this is the earnings for, I would say, about the top 50 Pakistani companies which are covered by brokers, and it's in Pakistani rupees billion. The earnings have been so strong. I mean, forget going back to pre-pandemic, going back to 2020 levels. The earnings have gone back to higher than even 2019 levels, especially as you can see towards the end of the chart, from third quarter 20 onwards, from 3Q 20 to 1Q 21. These numbers are higher than even 2019 levels. So it just shows you how strongly earnings have come back because of the not just pent-up demand, but because of the economic recovery that was already in place in many of these markets before the pandemic struck. And just talking a bit about earnings, I don't think earnings have peaked out in many of our markets, because if you look at what's happened in Vietnam over the past couple of months with this lockdown, and this for the past 6 months, they've had a pretty tough time with the cases and lockdown. So the earnings have not peaked out. They'll have a low base. The comps over from 2022 to 2021 will still be low. So there'll still be a low base comp for them as well. And same is the case for Sri Lanka. And also I would say to some extent for Bangladesh as well. So I don't think earnings have peaked out. In fact, earnings will come back pretty strongly for many of these countries in 2022. So in my view, earnings haven't really peaked out as yet for our markets. And also the chart on the right shows you it's not just about remittances and exports, but also higher commodity prices. We have some important markets that we invest in which are benefiting a lot from higher commodity prices, such as crude oil, copper, and uranium, etc. And that's obviously benefiting countries like Iraq, Kazakhstan, Mongolia, which is of course, for Iraq, it's only crude oil, which is it's a big benefit for them. But Kazakhstan is more diverse in terms of their commodity exports. They do crude oil, gas, copper, uranium, pretty much everything. And of course, Mongolia is benefiting from higher coking coal prices as well. And so that's a bit of what's driven, stock market sentiment within our markets in terms of earnings and the export recovery and high commodity prices. But also some structural trends which we are seeing, or which actually we were seeing even before the pandemic struck. But some of these trends have only accelerated over the past 18 months, and that's also helping, manufacturing grow or the industry grow in our markets. So, this manufacturing shift, I'm sure many of you know about this. I've read about this in the media about, supply chain shift into many of these low cost countries like Vietnam and Bangladesh. As the chart on the top left shows you, in garment exports, basically, it's Vietnam and Bangladesh which have taken market share from China over the last decade. China's lost market share to both these countries, and both Vietnam and Bangladesh, I would say, they always, it shifts in. They're almost not. It's either Bangladesh or Vietnam, which is number 2 in global garment exports. On a monthly basis, it keeps shifting. So pretty close, neck and neck. So it's these 2 countries which have taken market share, not India, not Indonesia, despite what a lot of the media says that manufacturing is moving to some of these countries, but actually the numbers suggest otherwise. Vietnam and Bangladesh are the countries which have benefited a lot, especially in garment exports. And even as the chart on the top right shows you, I would not be able to show you this chart maybe even 3 years ago. Vietnam has become so important in the global supply chain. Most large, well-known, established companies now have a large presence in Vietnam. And it's become so important that, Nike's stock price now gets affected because of what happened in Vietnam. So like I said, 3 years back, that would not have been the case, but it's only accelerated post-pandemic and also post the China-US trade war. And this just shows you how important Vietnam is as a production hub for many of these companies going forward. And I kind of preempt a question over here as well, with this lockdown happening in Vietnam over the last 5 or 6 months. And I'm sure you've seen a lot of media reports about production being affected in Vietnam, especially in the south of Vietnam, and some of the production being shifted out to China and some other countries. But I think that's not really a long-term solution, because any garment or footwear company which shifts production back to China, one, they're going to pay higher tariffs when they export back to the US, because tariffs are still in place, and 2, they're paying higher wages. So I'm not sure they will want to do that in the long term. It's not very sustainable, and they've already invested so much in Vietnam in terms of building the supply chain. So it's not that they can just let it go and move to some other country. And also from a capability perspective, I don't think many countries offer that capability. Yes, Bangladesh is strong in garments, but that's it. They're not even, they're not very strong in footwear, so you can't really move footwear production to Bangladesh. Indonesia's capacity is not very high for garments as well. So not many countries in the region besides China where they can shift back to. But like I said, it's not really a long-term solution because of the tariffs and the higher wages in China. So once the situation improves in Vietnam, I think you'll see less noise about supply chain issues coming out from the country as well. And just following on in terms of the export growth, especially for Bangladesh and Vietnam, as the chart on the top left shows you, I think most countries in the region would love to see these kind of figures, but unfortunately that's not the case. I would say only Bangladesh and Vietnam, amongst the larger markets in emerging Asia, have shown such kind of growth rates. Vietnam exports have grown by almost 15% cumulatively over the last 15 years, and Bangladesh garment exports almost 10%. If you put it in perspective, India's exports have grown about 6% over the last 15 years on a cumulative basis. And this is not a base effect. Vietnam's exports, I think they will overtake India in terms of absolute exports this year in terms of total number of exports. I think they'll do more than $300 billion in exports this year. I think India is going to do a similar number. So it just shows you how important Vietnam is and how well they've executed on their export strategy as well. And even the chart on the top right shows you, FDI in Vietnam of foreign direct investments, it's been consistent across the last 6 or 7 years. It's been 6% of GDP, which is, I would say, the highest on a long-term basis across ASEAN, especially across ASEAN or emerging markets in Asia. So it's been pretty consistent. And even in 2020, despite the pandemic, FDI hardly dipped. It was flat year over year. So not much of an impact from that as well. And just coming back to Bangladesh as well, a quick point over there. They're strong in garment exports, the number 2 in garment exports, but they're diversifying away in a very aggressive fashion. So the government is has got in place very good policies in terms of attracting manufacturers, because they're giving tax incentives, giving them, they're not having issues with acquiring land to put up factories, etc. So you're seeing a lot of automobile manufacturing, smartphone manufacturing, and of course pharmaceutical manufacturing move to Bangladesh as well. So Honda is already assembling motorcycles in Bangladesh. Xiaomi and Samsung have already begun assembling smartphones in Bangladesh. And pharmaceutical exports is being done by domestic companies. It's still small, but maybe give it 5 or 6 years, it's still about $120 million of exports a year. We're growing very fast, about 40% a year. So that should grow as well. So I would probably say, stick my neck out and say Bangladesh would be the Vietnam of South Asia, probably not the next 1 or 2 years, but give it 5 or 6 years. I think that'll be a similar story over there as well, because they are getting these policies in place, they're giving the tax incentives, and they're building the infrastructure also. So I think Bangladesh is one of the top stories out there from, in general, a macro and a manufacturing growth story. And it's not just about garment manufacturing or the supply chain shift into Vietnam. It's also other factors which are coming into this whole supply chain shift definition. So as the chart on the top left shows you, because of the China-Australia geopolitical tensions, the Chinese coking coal imports for China from Australia have gone from basically 50% to zero, so in 1 year or less than a year. And with the country which has benefited the most has been Mongolia, because of the border they share with China, and because coking coal is one of the most important products they produce. So they've basically increased their market. They've almost doubled their market share over the past 3 or 4 quarters. So that's also one of the supply chain shifts that we're seeing within our markets, and which is benefiting our markets. And therefore, Mongolia has done well. The stock market has done well also so far this year. And also, as the chart on the top right shows you, Sri Lanka. Not many people talk about it, but this I would say is in a way a supply chain diversification, right? I mean, container shipping lines are consolidating. The ships are getting bigger. They're carrying many more containers, so they won't drop off all their load or containers at a large transit hub. And Sri Lanka, Colombo, that's what it's transforming into. As you can see, as the chart shows you, it is the busiest port in South Asia, which I'm sure maybe many people may not be aware, but it's the busiest port in South Asia, despite being a very tiny country. But that's because of the fact that its strategic, its geographic location is so strategic, just between east and west lanes in the Indian Ocean. So very important location. And most of the container shipments going through Sri Lanka, basically transshipments to India and also rest of South Asia. So I would say 80% of container shipments in Sri Lanka or Colombo are transshipments to the rest of South Asia, especially India, and then of course Pakistan, Bangladesh, and Myanmar as well. And the port of Colombo will actually be increasing capacity. There are about 8 million TEUs right now, and they'll go to about 14 million over the next few years. Maybe give it 3 or 4 years, but that's what they'll get to in the next few years as well. And that will make it amongst the leading ports, I would say, in Asia from a capacity perspective. And some of the other trends that some of the investors ask us about the vaccination rates in our country and how vaccination is going. So it varies from country to country. I mean, I would say for most of the developing world, the numbers are still low. But 2 countries that stand out, I would say, is Maldives and Sri Lanka. They are basically, as the chart on the right shows you, they have the highest vaccination rates in Asia. I would say pretty much in emerging markets in Asia. I mean, higher than Philippines, Indonesia, Thailand, India, Vietnam, pretty much everyone. And they've been pretty aggressive because of the fact that tourism is such an important industry for them. So they both are about 60% in terms of total vaccination. This is both the jabs, the whole population. And that's really helping them open up the tourism economy. In fact, as the chart on the top, on the left shows you, Maldives was actually anyway open for tourism from July 2020 onwards, even before the vaccine was out. And they've seen, and post-vaccination, etc., they've seen a very strong recovery in tourism inflows. In fact, they've almost gone back to pre-pandemic levels. And I think from some of the companies we speak to, which are listed in Sri Lanka and have operations in Maldives, I think they all are saying that they've got full bookings for the peak season, which runs from November to March. So it's going to make a pretty strong comeback. And even Sri Lanka, which is now seeing a very high vaccination rate, their COVID situation's improved a lot. they're seeing about 500 cases a day, which is pretty much nothing for the size of 20 million people. I mean, they've been removed of the red list. UK has removed Sri Lanka and Maldives from the red list. And as I mentioned, both countries are coming into the peak season, and this will really benefit Sri Lanka much more because they've hardly had any tourist inflows since pretty much 18 months now. So it will be a big boost for their foreign exchange reserves, especially now when they have the external repayments coming up and with the current account deficit, etc. So it really help not just the tourism industry, but I would say the overall macro situation in the country as well. And this will really help lift even sentiment amongst the population as well, I would say. And just also on just sticking to the vaccination part, even Vietnam, I would say many people have, as you know, had a tough time over the last 5 or 6 months. But as the chart on the top left shows you, I think active cases have come down significantly now. I mean, they were doing, the whole country was doing about, at the peak, 13 to 14,000 cases a day. They come down to about 3,000 cases a day. Ho Chi Minh City was doing about 7,000 cases a day. They've come down to about 1,000 or 1,500 cases a day. And so the cases have basically come off because vaccination has been very aggressive. So it's still low compared to developed markets or compared to Hong Kong and Singapore. But it's about 25% of the population has been vaccinated, but it's very aggressive. So they target total vaccination rate of 70% by the first quarter of next year. But actually, most of the adult population in Ho Chi Minh City and Hanoi is actually fully vaccinated, and that's why they've been able to reopen the economy. So I think now the economy is pretty much reopened in Vietnam. I was just reading today that Ho Chi Minh City allowed restaurants to reopen today for dining in with 50% capacity. So they're coming back to some normalcy as well now. And also the chart on the right, it shows you that this is a stringency index. I think it's calculated by Oxford University and also Bloomberg. Basically, the trend line is downwards, right? So they've gone back to where they were in terms of how strict the lockdowns, the social distancing requirements are. They've gone back to basically beginning of 2021. So basically, the economy is reopened. And as the last bullet point on my slide shows you, pretty much all the factories in the large cities like Hanoi and Ho Chi Minh City are back to business. So 100% of factories in Hanoi have reopened, and almost 100% of factories in and around Ho Chi Minh City have reopened as well. There was just on the report I was reading that of the large industrial parks in Ho Chi Minh City, which employ about 300,000 workers, I think 250,000 workers have already returned from their from their villages or from the other cities that they were living in. And just another structural shift we're seeing, I'm sure many of you have probably noticed this also in other markets as well, this whole digital shift and fintech shift. It's pretty hot in Asian frontier markets as well, especially in countries like Bangladesh. As the chart on the left shows you, these are basically the cashless transactions which happen through phones, through an app, in billions of US dollar. And they've gone from pre-pandemic 4 billion to 8 billion. So they basically doubled in the span of 18 months. And that's a huge shift. I mean, it's basically changing people's behavior. Smartphone penetration is still very low in Bangladesh, less than 20%. Even in Pakistan, is less than 20%. So as that increases, you're going to see this number only increase going forward. And that's benefiting a lot of these companies which are building apps. One of them is Bcash in Bangladesh, which actually got funding from Ant Financial in 2018, and that could see pretty good growth also going forward. And the chart on the right, I mean, just to get a bit technical, this is the total payment value, which is the in short TPV, which is the amount of dollar transactions that are transacted on these apps across various of these app companies in various emerging markets, including ours. And the red bar charts are the ones which are part of our universe. So Kaspi, Bcash, and JazzCash. And just to put this in perspective, I mean, Kaspi actually is listed in London. Its TPV is almost $100 billion, and this is a population of 18 million people, not 200 million people like Nigeria or Indonesia. It's just 18 million people, and it just shows how things have changed in our markets. I mean, 75 to 80% of transactions in Kazakhstan now happen digitally, not through cash, which wasn't the case maybe even 3 years ago. In fact, even in 24 months ago. And even Bcash, their TPV is $67 billion. So I was just seeing that in Paytm in India is doing an IPO But there, if I look at the numbers over there, their TPV is $55 billion. So yeah, it's a great story over there. But I think sometimes Asian frontier markets also have similar stories, and in fact, their TPV numbers are even higher than some of the other hot stories in, say, India or Indonesia or ASEAN. And in fact, Kaspi is actually making money. They'll do $1 billion in profits, net profits this year. Yes, I repeat that again, $1 billion in net profits, which most of these companies are not even making money. In fact, they're burning cash, but Kaspi is making money. So in fact, their market caps just touched $27 billion just yesterday. They declared results a couple of days ago, and they again raised their earnings guidance for the year. And this is just a quick snapshot in terms of the stock price performance. Kaspi's outperformed pretty much every company in the emerging market and fintech, emerging market and frontier market tech universe. And just a quick snapshot, quick comment on e-commerce as well. If you look at the chart on the top left, I mean, it's just $2 billion of e-commerce market size industry for our universe, very small, a lot of room to grow. And also in Pakistan, we're seeing a lot of funding happening for these tech startups. So I think give it maybe not 1 or 2 years, but give it maybe 3 or 5 or 6 years, you will see some very interesting IPOs coming from our markets as well going forward. Yeah, so I gave you a pretty good rosy picture as to why our markets are doing so well, and it's such a great story, and you know why you should be investing in Asian frontier markets. But there could be some headwinds as well. So of course, I think the high crude oil prices will be somewhat of a headwind, at least in the near term, and that would affect some countries like Pakistan and Sri Lanka, simply because of the fact that the macro is slightly weaker than Bangladesh and Vietnam, and especially Sri Lanka, because they have this external repayment issue happening for the last couple of years, so that they could face some pressure. But having said that, it's not as bad as it seems. If you look at Bangladesh, as the chart on the top left shows you, their debt to GDP is still so low. They manage pretty well, very consistent. And even their FX reserves, the foreign reserves are very high. They've almost doubled over the past 18 months. And even Pakistan, the situation over there is not as bad as 2018. The current account deficit will be about 3% this year compared to 6% in 2018. Their foreign exchange reserves are at all-time high compared to 2018 when they were all-time low. So I think the situation is not as bad as some people, you know, as the market makes it out to be. In fact, the currencies appreciated over the past couple of days now. And even Vietnam, I think I don't need to tell the story again. Very strong macro, current account surplus. As the chart on the left shows you, they'll come back to GDP, you know, strong GDP growth from next year onwards. And even as a chart on the right shows you, despite the pandemic or despite this lockdown, they've had the last couple of months, you know, exports to US have been very resilient compared to 18 months ago. They were doing about 4 billion or 5 billion a month. At the beginning of 2020, they're doing about 7 billion now. So it's pretty strong. And Uzbekistan, again, great reform story. They're one of the few countries, as the chart on the top left shows you, which showed positive GDP growth last year, despite the pandemic. Debt to GDP levels are very low. They'll come back to about 6% GDP growth this year and also going forward. As the chart on the right shows you, again, very strong foreign exchange reserves. So macro is very strong over here as well. So no, I would not be so concerned about, you know, high crude oil prices or high commodity prices causing a crisis in Uzbekistan. And like I was saying, I mean, it's not as bad as the media makes it out to be. The currencies in our markets have been pretty stable. I mean, the worst performing is probably Sri Lankan rupee from our larger markets, about 9%, and Pakistani rupee at about 8%. But you know, it's still low compared to what's happening in Turkey or Argentina. So still, overall macro situation is not as bad as it seems. And even the Vietnamese currency actually appreciated this year, and the Bangladesh taka is just down 1% this year because of its strong macro position. So you know, why should you be invested in Asian frontier markets? I mean, this chart is a pretty simple explanation. I mean, GDP growth in our markets, and this is from the IMF, for the latest estimates they've put out a couple of weeks ago. This for our universe, it's almost 5% GDP growth over the next 5 years compared to the other, I would say, many of these buckets were frontier markets: Sub-Saharan Africa, Latin America, emerging Europe, pretty much frontier, and they're doing much lower growth rates than Asian frontier markets. Because growth is so strong in our markets, Bangladesh, Uzbekistan, and Vietnam will be showing 6% plus positive, 6% plus GDP growth rate over the next probably 3 or 4 years. It's a very strong growth rate because of the fact that you have this manufacturing shift. You've got reforms happening, you've got pretty strong macro, and we've got strong demographic, which I'll talk about now. Very high pop, as the chart on the top left shows you, it's a sizable population. I mean, Pakistan has a population of more than 200 million people. Bangladesh is at 165 million, Vietnam is 100 million, and Uzbekistan is about 25 million. So it's a sizable population, a sizable consumer base to tap, which is backed by a young population. As the chart on the right shows you, as I mentioned earlier, the average age in Pakistan is 23 or 24, and in Bangladesh is about 27. So the median average for our universe is about 28, which is still young and gives a lot of room for consumption to grow. And this is just a quick snapshot. It's strong GDP growth. It's a large population. It's a young population, and this leaves a lot of room to grow the consumer market within our universe. I mean, for example, in Bangladesh, penetration of consumer appliances is extremely low. Even automobile sales in our markets, as the chart on the right shows, top right shows, it's very low, and the bottom chart just gives you a snapshot as to what is the potential for modern retail penetration in our markets. In Ho Chi Minh City compared to, say, even Bangkok, still a lot of room to grow modern retail over there as well. And this is just a quick snapshot of some of our top picks. Maybe not all our top picks, but some of the companies we like. And just a couple of things I want to highlight here. Over here is, if you look at the PE ratios and the earnings growth, I mean, majority of the PE ratios over here are less than 10 times. And even the PE ratios which are slightly higher than more than 15 times is not exorbitant. It's not like 50 times like you're paying in India or Philippines. You're paying 30 times for Universal Robina, if I'm not mistaken. I mean, and the companies which have a higher PE ratio of 20 times or 19 times, they have a very strong earnings growth over the next 12 months because of the fact that they're seeing a strong economic recovery in Vietnam. And even the other thing I would like to highlight is the strong earnings growth across the board, not just for the high PE companies. So you're getting growth at a very reasonable price over here. You're paying P's of 6 times, 7 times, or 8 times, but you're getting growth of 15 to 20%, and sometimes even more in many of the companies. So pretty strong focus for earnings growth, pretty strong earnings recovery in our markets. And also one more thing I will highlight for these companies is they're all consumption focused. So it's all linked to the demographic story I was telling about, which is linked to the high population rate, the young population, which leaves a lot of potential for long-term consumption. And all these companies in one way or the other are linked to consumption, even if they're in cement. End of the day, Pakistan requires a lot of cement consumption because of the fact that people are building houses, etc., and there's more urbanization happening in our markets as well. Telecom as well, indirectly is consumption driven, and so is banking and financial services of fintech, which again is consumption driven as well. So again, snapshot is very strong consumption driven growth, very attractive valuations, and very strong and stable earnings growth for our markets. Having said that, our markets, like I said, have done very strongly, done very well. You have very good opportunities, valuations very attractive, but still, I think the interest in Asian frontier markets is not. I would say they're still under research compared to some of the larger markets like India and Thailand or Indonesia, and still ignored. In fact, much more ignored now compared to 2 or 3 years ago. I think Thomas will elaborate on those points much better than me. So over to you, Thomas.
Thanks, Ruchir, for the detailed presentation. As you heard from Ruchir, we believe that Asian frontier markets have sound fundamentals and the economies should continue to perform well in the future. However, despite the great investment outlook for Asian frontier markets, foreign investors have reduced their investments in these markets, not only in Asian frontier markets, but also in global frontier markets since some time. As you can see on the left chart, for Bangladesh, Pakistan, and Sri Lanka, foreign investors started selling them in 2018, and with a small exception in 2019, continued to do so in 2020 and 2021. And even what we believe is a great investment story like Vietnam experienced net foreign selling in 2020, which also increased dramatically to $2 billion this year, as you can see on the right-hand chart. Next. The wave of selling by foreign investors had obviously also a negative impact on the fund size of global frontier funds. For example, the fund size of Schroder Global Frontier Fund dropped from almost $1.8 billion at the end of 2017 to currently 403 million. Or, for example, Morgan Stanley's Global Frontier Fund, AUM, declined from about $700 million at the beginning of 2018 to $150 million today. Next. The exodus of foreign investors from frontier markets impacted also our AFC Asia Frontier Fund. The fund size dropped from a high of $25 million to now $12.5 million. On the positive side, however, the fund's valuation became more attractive. When we launched the fund back in 2013, the average PE was 13 times and went up to 17.5 times in 2017, and thereafter declined last year to 7.6 times on average only, and currently trades even despite the nice performance, in our view, at an attractive 10.3 times PE and a dividend yield of 3.2%. Next. Despite the fund's rally in the past 12 months, as I said, the fund's valuation is with a PE of 10.3 times, a price book ratio of 1.2 times, and a historical 3 years earnings growth, average earnings growth of 16.3% of the underlying companies, still very attractive compared with other Asian emerging markets like Indonesia, which trades at 25.3 times PE, or Philippines, which trades at 24.8 times PE right now. Next. To conclude this presentation, we believe that it's now a good time to invest in Asian frontier markets, since the valuations are still very attractive compared with other markets, with other emerging markets or developed markets, combined with an outlook for strong earnings growth, and that in an equity class which has been completely shunned by foreign investors in the past few years. Imagine what will happen if and when, hopefully, foreign investors are discovering the frontier markets again. It will be like a stampede, and therefore you should invest in Asian frontier markets before the crowd comes in back again. Now to Q&A. As I said at the beginning of the presentation, you can submit your questions through the icon on the bottom of your Zoom window, and we have already received some questions, and I will read them out now. And let's see, Ruchi and myself will try to answer them. So the first question we received was, what fees do you charge when investing in in-house funds? So it's basically relating to our funds holding in Asia Frontier funds holding in our in-house funds of AFC Iraq Fund and AFC Uzbekistan Fund. And the answer is very simple: is we are investing in a share class which doesn't charge the Asia Frontier Fund any management fee and performance fee. So there's no double layer of fees. Then another question we received is, you mentioned several positive factors about Pakistan, like recovering earnings, aggressive interest rate cuts, yet the stock market has been going down. What have been the issues that are holding the market back? So I can think I had already some advantage to Ruchi here, so I can think of three items. First of all is the market performed pretty well the first couple of months this year, but after the Afghanistan issues, the market stopped rising and declined, anticipating some kind of overflow of this situation or political difficult situation into Pakistan, because both countries share a long border and they're ethnically very close and so on, and the trade flow goes, because Afghanistan is very mountainous, so a lot of trade flow goes through Pakistan near Rawalpindi, Islamabad. So that is certainly one factor. The second factor is that Pakistan, until I think at the end of this month, is still in the MSCI Emerging Market Index, where it's only 0.3% or something. So it's basically nothing. But this will change next month. Pakistan will go into the MSCI back into the MSCI Frontier Markets Index. So a lot of people say it's a downgrading of the country, but actually I personally think it's an upgrade because, and that we will see that next couple of months will prove it, because more people then will again invest or can invest, and especially frontier markets like us can, frontier market funds like us can invest in Pakistan again. So, and I think Pakistan will have in the Global Frontier Index a weighting of between 8 to 12%, if that is correct, Ruchir. And so there should be some interest coming back. So I think that should change. Third thing is that, yeah, the forex situation, the foreign reserves of Pakistan is always very tight, has been tight for the last 20, 30 years. They're right now in discussion with IMF for another program. They're going into another program for funding for foreign, to get more foreign exposure reserves. So that's also certainly not helping. Yeah, another issue is always that Pakistani banks are on a grey list by OECD. That's also holding back. I don't know, Ruchir, do you have anything else to add here?
Yeah, I think a couple of other reasons why the market has been weak is the fact that, I think most, since it's a commodity important country, local investors get pretty tense when oil prices increase so fast and so in such a such a significant fashion, especially when, the current account was already just marginally positive a couple of months ago, and that's turned negative now. And therefore that kind of, makes them a bit tense. And plus that's also led to the State Bank of Pakistan, which is the central bank, to increase interest rates. So, as interest rates are increasing in Pakistan, the local investors get a bit edgy as well, because they expect, they obviously the discount rate increases, and they could probably, lead to some profit taking or some sell-off in the market. But, as Thomas mentioned, the sell-off started happening only in the last couple of months. They were doing pretty well till August, till this whole Afghanistan issue happened, and downgrade to frontier markets happened again. So I think once they go back to the frontier market index, especially once they announce the IMF program again, which I think they'll announce any day soon now. In fact, I would say probably in the next 10 days, that could give some confidence to investors again, which could re-rate the market. In fact, the markets come back a bit strongly now in the last 2 or 3 days, because government is saying that they almost closed the deal with the IMF. And also the current account, though it increased, but on a month-on-month from September to August, it's down 20%, because the weaker currency and also high interest rate is now leading to a softening of the current account, which is also reducing some of the pressure in the market. So I would say, give it some time. I think you'll see another recovery, another move up towards the end of this year.
Okay, thanks. Another question is, Bangladesh is moving away from garments to tech, auto, and consumer-based industries. Do you have any investment in consumer discretionary or automobiles industry of Bangladesh? Ruchir, I think that's easy.
Yeah, I think consumer discretionary should be invested in one of the leading consumer appliance manufacturing / assembling / retailing companies, which is Single Bangladesh. It's a very well-known brand in Bangladesh, one of the oldest brands. So they basically assemble and manufacture, assemble refrigerators, air conditioners, washing machines. And also they have one of the largest retail chains in the country. So we invested in that. In fact, Single was acquired by Arçelik of Turkey a couple of years ago. And that's also helping them improve the product line, improving their efficiency, their supply chain as well. So that's our exposure to, I would say, consumer discretionary. On the auto side, there are a few listed companies, but nothing which is, it's not, some of them are very small or loss-making. So nothing, unlike Pakistan, where you have, Toyota and Honda, which are listed, and even Suzuki, which is listed in Pakistan, subsidiaries. You don't have that in Bangladesh as yet, I would say. But maybe, who knows, sometime, some few years down the line, that could happen. So I would say consumer discretionary is via Single Bangladesh.
Yeah, and then we have consumer staples, British American Tobacco, which is doing very well. And also, let's say our pharmaceutical company, is doing more OTC. I mean, used to do a lot of OTC products, so it's also consumer related, I would say. Okay, then another question: are you reducing exposure to Mongolia, your largest country, if I remember, given commodity-linked performance, or do you expect this to continue? Okay, basically, yes, we think commodities will continue, especially some of them, like uranium. So we have a holding in Kazakhstan from Kazakhstan. We have trimmed down, we have sold some of our holdings in Mongolia, but the market is still doing very well for us. And actually, next month, we're going to invest in an IPO, very interesting IPO in the consumer sector. There, we're going to invest in an IPO, which is in a company which is setting up a 7-Eleven chain in Mongolia with the help of a very successful chain from South Korea. Then here, how are local currencies impacting the fund, and how do you see the FX rates impacting the fund's performance here in Swiss franc going forward? I mean, I can say Swiss franc. So we only think about US dollars. So being Swiss, I think Swiss is the best currency in the has the currency with the best, one of the best fundamentals in the world. So Swiss franc and Singapore dollar. So it's a tough question. So Swiss franc, I think, versus the US dollar will strengthen. So that's certainly not helping Swiss franc investors. So maybe Ruchir, you want to talk about local currencies to US dollars?
Well, I mean, as one of my slides I showed you was the currency movement so far this year. It's not like it's falling off the roof, right? I mean, you have pretty good central bankers, pretty good people in place to manage the finances and the whole situation. So the Sri Lankan rupee is down 9%. The Pakistani rupee is down about 8% this year, but in fact, it's appreciated about 1% in the last 2 days because of the fact that Saudi Arabia has just given some funding to Pakistan and they could announce the IMF to deal anytime soon. So yeah, I mean, some concerns, but I would say, like I was saying, the macro situation this time around is much better. Say, for example, in Pakistan, compared to 2018, when you had higher crude oil prices, when they had very low foreign reserves and very large current account deficit. So I would say it's a bit overdone in terms of Pakistan. And Sri Lanka, of course, that's a bigger concern. That's more long-term structural issue for them because of the fact that they got a lot of external debt and some repayments coming up next year as well as going forward. But for them, I think you've got to put it in perspective that they were a tough few years. You know, they had political instability in 2018. In 2019, they had the Easter Sunday attacks, and of course, then the pandemic in last year. So some of their big foreign exchange drivers like tourism have basically gone back to zero now, and they were doing $5 billion pre-pandemic. So even if they get back to 20% of that number in the next, say, 12 to 18 months, that'll be a big positive for them, not just for the currency, but it's overall the FX position, the FX reserve position, and the overall macroeconomy. So yes, I'm not so concerned. Maybe Sri Lanka would be one concern, but our weight in the country is less than 6% because of the fact that we're not so sure about the macro. The other countries, like I mentioned, Vietnam, very strong macro. The currency is appreciated this year. Bangladesh, very strong macro, just 1% depreciation, which is normal for any emerging market. So yeah, much better performances compared to some of the other larger emerging markets globally.
Yeah, and I mean, it's important to say that we don't hedge the currencies. So if you're bearish on a country, so we will reduce our exposure. On a country's currency, we will reduce the equity exposure in order to minimize the risk or reduce the risk. So here another question, a little bit different. Are you maintaining a Kazakhstan or Bangladesh fund similar to Uzbekistan or Vietnam fund? If so, can I participate as a US citizen? No, unfortunately, we don't have that. So we only have, as you said, the Uzbekistan, Vietnam. We have also a fund in Iraq, and then this global Asian fund, Pan-Asian fund, Pan-Asian fund, the AFC Asian Frontier Fund we're talking here about. So if you want to invest in Kazakhstan or Bangladesh, it's only at the moment through AFC, through this fund. And then one or two questions, I think they're pretty good. I wrap them together. It's one question is, can we talk about the top 3 positions? And one is particular about our largest position, which is Hai Dong Pulp, a Vietnamese pulp manufacturer. What is the story behind such a large allocation in what appears to be fairly illiquid share? Have you been increasing or reducing your position? How has it performed? Do you still believe in it? So Hai Dong Pulp is one of our first investment. They are producing pumps. When we started to invest, it was around 10,000, between 10 and 15, 12,000 Vietnamese dong. Now it trades at 30,000 dong, but it had several times some kind of bonus shares. So we probably made 3 times our money. We got dividends and so on, and it was so far a very good investment for us. And the investment grew because of the performance as well. But we are still convinced about this investment. As I said, they're producing pumps. They're not small pumps. They're the big pumps. They used, when we invested, they used to produce pumps for for power generation, so huge pumps, 10, 15 meters high, or also pumps for agriculture. And now then, due to global warming, Vietnam sees some more of this seawater going into the Mekong Delta, which then is destroying aquaculture or agriculture, and also sees flooding. So this company has received a lot of orders. I mean, and they don't just receive it; they had to really competitively bid for these orders. In the Mekong Delta from the Vietnamese government to install big pumps to move water, or in order to reduce flooding and or seawater going into the Mekong Delta and destroying the shrimp or fish farming there. But what is very important is so this company, yes, they're producing pump. Maybe the margin are not really that great, and they also have some tie-up with foreign companies from Japan, and now also Austrian companies working together with them. But where they really make the money is it's a little bit like elevator business, like Schindler from Switzerland. They're producing the elevators, but they don't make a lot of money, or sometimes even on some prestigious building, they're losing money. And where they make the money from is from servicing these elevators afterwards. And the same is valid here for these pumps. So they're selling the pumps, and afterwards they're making the money from servicing these pumps, because they need to maintain. I mean, there's water, there's humidity, there's heat, and so on. So they need to be maintained. So yes, we believe in this, and we think it's a very interesting company, and we know that other companies from the same industry are looking at this company for tie-up or whatever. Yeah, here another question: is it possible to get the slides of this presentation? Yes, we will send all the investors who have registered to this call a link for, we are recording this call, a link to review this call, and also to get a link to the presentation, what you have seen in the last 55 minutes. Then here, how is that frontier stock markets have no correlation to China, even though the economies are tightly interconnected? Chia, you want to talk about that quickly?
Right, but because I mean, if you look at the interconnectivity, it's more trade related, right? It's not if Evergrande goes bust in China, that's the Vietnam economy is going to go bust, or the Pakistan economy is going to go bust. So Vietnam depends a lot on China for the raw materials. So that doesn't really affect. I mean, what happens to real estate or financial service doesn't really affect Vietnam as such. But I would say yes, from a supply chain perspective, it does affect Vietnam. Not just Vietnam, but I would say pretty much everyone which depends on China for raw materials because of the power shortage they're having right now. I mean, we were just talking to a Bangladeshi pharmaceutical company yesterday at a conference, and they import. I mean, China is the biggest producer of APIs, which is the raw material for making the pharmaceutical products. And this company was saying that they're facing some issue because of the low factory production in China for APIs. So yes, from a supply chain perspective, I think this would affect not just Asian frontier markets, it would affect pretty much every country which is depending on China for raw materials for their end production. But purely from a sector perspective, say real estate or something of that sort, I don't think it really affects Bangladesh or Pakistan or Sri Lanka that much from a direct perspective. But like I said, from a supply chain perspective, yes. And of course, if China goes from 5.5 to 6% GDP growth to 2% GDP growth, that's not a problem just for Asian frontier markets. Markets is a problem for the whole world. So that's something we have to watch out for. But purely from, I think what I was trying to say that for the last couple of months, there's been so much talk about Evergrande, and that's why China's been weak. It's not really affecting Pakistan or Bangladesh or Vietnam, and also the tech crackdown in Alibaba and Tencent and all these tech companies or Meituan. That's hardly has any connection with Vietnam, right? Because a tech crackdown in China doesn't really have much of an impact in Vietnam or Kazakhstan or Pakistan. Because one, they don't have many tech companies listed, and two, it's not at all linked with what China is doing to their tech companies out there. So yeah, I would say from a direct perspective, from an indirect perspective, not much impact, but yes, from supply chain perspective, there could be some impact.
Okay, great. I see it's already past 10 o'clock, past the hour. Therefore, this concludes our today's seminar because there are still a lot of questions. We will reply to this persons who ask this question directly later on after the seminar, after this webinar. And again, thanks a lot for attending our webinar today. And since we couldn't answer all the questions, you can get in contact with us or through email or visit our website. Additionally, we have recorded this webinar, and you will receive an email with a link to the recorded webinar and also a link with the presentation. And of course, as usual, we will send out a monthly newsletter. You will hear from us through this channel. And in the future, as Ruchir and me already mentioned, we tend to hold this kind of webinar on a half-yearly basis for the AFC Asia Frontier Fund. Stay safe and good night from Hong Kong. Thank you very much to everybody.
Thank you. Bye-bye.
Thank you. Bye-bye. Take care.